Appreciate you guys having me this morning. And as Ali mentioned, I could have put together a PowerPoint, could have done some presentational sorts of things, and that's not typically the way that I do this. I could really talk on this subject matter, which is everyone's favorite subject matter, taxes, right? I could do this for hours. So really what my plan is this morning is we're going to go over sort of some high level things specific to your industries, which I understand there's a lot of realtors, probably brokerage side on the call here today. So we're going to go over some things specifically with your industry, mainly, maybe some high level, just things to consider. When we might get into some specialized topics here, again, that's going to be specific to your industry. As Ali said, I don't mind as we are going along in this presentation. If you have questions, please put them in the chat box. We can stop, especially if it's something we're currently working on. I think it makes sense for us to sort of stop, talk about it, because I'm sure there's others on this call who are going to have that same question. So this is going to be sort of laid back. We're going to get into some high level. We're going to dig down into some details. And hopefully you guys are going to come away with this with some pretty good information here. A little history about myself, a little bit more than what Ali just mentioned there. We do have a lot of clients in the real estate realm, pretty well versed in this area. A lot of real estate brokers, a lot of property management companies that I deal with, a lot of flippers, a lot of long-term rental, residential and commercial folk that we deal with, and then a lot on the construction side. So your residential and your commercial contractors. So it's an area that I deal in quite a bit. And so I think I've got a little bit of an inside route. Not going to say more or less than any other CPA. It's just an area that I am pretty well versed in. So where I sort of want to start today is let's start on the real estate side. You're an individual real estate broker. Again, I think that's probably the majority of the folks on the call today. And, there's several ways to set yourself up for success. I'm sure there's a lot of you on this call who are just sole proprietors. It's your name. It's your social security number that you operate as, and that's completely fine. You may have some folks on here that have started an LLC, have formed a team. I do understand that forming teams these days is a pretty popular route to go. And I believe the Virginia Association of Realtors almost requires you to have an LLC in place if you do have a team that you're dealing with. And then we'll go a little bit further and say any of you folks that have LLCs that have made an S corporation election, or potentially there's some folks on this call who have gone the corporation route from the very beginning. And again, we'll talk a little bit about all of these different setups. There's no one right answer. And again, we'll talk a little bit about each. Now, whether you're any of those forms of business, the one thing that I like to tell clients about taxes and how to best manage your business when you're in this industry is, again, this is probably more for the sole proprietors, but let's treat this as a business. And what I mean by that is, don't run commission checks and expenses for the business and those sorts of things through a personal bank account that you're also paying personal bills out of. I think you should really have a separate bank account that you're tracking your commissions, your income, you're paying all of your expenses. And as weird as it sounds, but if you want to pay yourself from the business, write a check from that checking account over to your other account where you pay all of your personal bills. It's going to make things very clean. It's going to really help you during tax time. And it's going to help someone like myself being able to advise you throughout the year on where you've landed and how we're going to manage those tax bills and how we're going to make sure that you're not hit with any surprises at the end of the year. So that's really going to be first and foremost, is you are running a business, because as of most of you probably know, your industry has a standard, and that standard is that you are a 1099 commission-based contractor for whatever brokerage house that you're working for. And that hasn't always been the case. Some of you on this call, maybe previously, could be 8, 9, 10 years ago, was sort of the timeline that I remember. You may have worked as a realtor in this industry, but you may have been a W-2 employee at that point. And when you're a W-2, it sort of makes your tax situation fairly easy. You're making money, you're going out there, you're working, but you're having all your taxes withheld. The brokerage house is taking care of all of that for you, and you follow your returns at the end of the year, and no big deal, right? But I would probably assume that most, if not all of you, are 1099. Taxes become an issue here. You have to sort of put together a set of books at the end of the year. You have to make quarterly tax payments throughout the year. And while that is a lot of work to pull all of that together, it's not necessarily a negative. There's a lot of things when you are a 1099 contractor that you can benefit from. Some things that you're able to deduct that when you're a W-2 employee, you cannot deduct. And you can get fairly aggressive in this situation with saving for retirement, which ends up being a huge tax deduction for you as well. So just keep all of these things in mind as we're sort of going through this presentation here. So, obviously you guys are out there working. I know the past couple of years have been tremendous and amazing. Maybe things are sort of at the top right now, but, everything that I've read and realtors that I'm working with and folks who are in this industry, things are at the top, but there's really no indication that it's going to come back down either. So it's one of those things where you're out there, you're making money, you're good at what you're good at, but then having someone like myself or even you managing the expense side can really come in handy again throughout the year. So let's talk about expenses, because income is what it is, right? You're out there, you're good at this, you're selling houses, you've got commissions, so the income's there. Let's talk about expenses, because that's really where people want to spend most of their time. So when we talk about expenses, again, you are a business at this point. All of your typical hard expenses, which are going to be all of your dues, supplies. I know a lot of realtors that end up having cost and money going out, whether they're staging a home, putting signs in front yards. They may even take on the expense of the person selling that house, some of the maintenance items, and I've seen that before, and all of those things are deductible. All of the hard expenses to make this money are all going to be deductible. Don't forget about insurance. Everyone should have E&O insurance. I'm sure you all do. But even over and above the E&O, may not hurt to even have just sort of a general liability or a general umbrella policy. Of course, those things can all be taken out even against your personal residence, under your homeowner's policy and things like that. I have a lot of realtors that do that as just sort of an extra layer of protection. And again, all of those things are going to be fully deductible against that income that you're making. Now, there's going to be some expenses, and a lot of these are going to be fairly large for realtors, are going to be things that are sort of a mixture of business and personal. And so really what we're talking about is we're talking about cell phones, right? There's going to be a little bit of personal, probably the majority business. Realtors are on their phones 24/7. It's going to be internet in your home. Are you sending emails to clients? Do you have a home office? And we can get into a little bit more detail about the actual home offices. The only thing that I'll warn you about the home office is it needs to be a true home office. And what I say by that, let's not have it be the kitchen table. Let's not have it be even just a desk sort of in the corner of a family room. It sort of needs to be its own set aside, closed door room that you utilize as a home office. And in that case, you can take the square footage of the home office, compare that to the square footage of the entire home, and whatever that percentage ends up being, which in most cases is 10, 15, I've seen as high as 30% home office. You can take all of your expenses of that home, whether if you rent, part of the rent, if you own your home, obviously portion of the real estate taxes, mortgage interest, utilities, even typically some repairs and things like that, you could throw into that bucket. Now, those are sorts of expenses for the home in total that are going to apply to that percentage. But obviously, if you have a home office and you are specifically buying desks, printers, computers, and things like that for the home office, you don't have to apply that percentage to expenses like those. Those will still be a 100% write-off against your income in the year that you're spending. Another big, huge item for realtors is obviously going to be the mileage that you're driving on a personal vehicle. And as hard as this is, I will probably suggest that you do find a way to physically track your mileage throughout the year, whether it's a little notepad in your car, which I do have a couple of clients that do that. And I don't necessarily request that they give that to me at the end of the year when we do taxes, but at least I know that they have it, sort of just tell them to give me their totals. But there's a lot of really cool apps these days that you can put on your phone. And again, I know it's hard to track, but at the end of the day, you really should be giving some effort to not just estimating it at the end of the year, but really trying to track it throughout the year on what your miles are. And of course, with the way gas prices are this year, the first half of 2022, the rate was pretty high. It was about 58 cents a mile was the standard rate. And then halfway through the year, again, because gas prices were so high, it jumped up to like 62 or 63 cents per mile. So it's a pretty large deduction. If you drive 10,000 miles for business, that could be a $6,000 deduction against your income. It is a pretty large deduction that you can throw in there for something like mileage. One thing I did want to talk about, because again, this comes up all the time, is going to be the consideration of whether your business can actually buy a vehicle and can actually write off the cost of that vehicle against the business income. And the answer to that is yes, but there are a lot of considerations and a lot of hurdles here that I think it's very important that we talk about, because this is a hot topic. One, if you are a sole proprietor, you cannot purchase a vehicle and write off the purchase price of that vehicle in your business, because technically you're not a business. You know, again, technically, because you're not an LLC, you're not a corporation. So you own that vehicle personally and you can take mileage. If you have an LLC, if you have a corporation, technically, yes, you can buy a vehicle in the name of the business. Of course, you're going to have some hurdles there if you're getting a loan, you know, whether you can get a loan in the name of your business and things like that. But it's fairly easy to go to the DMV and actually title a vehicle in the name of your business. And that's really all you need, is to have that title in the name of the business. Before you do that, though, you need to determine that overall that vehicle is going to be more than 50% business use. You know, if you are going to buy a vehicle and say it's for your business, but it's only 30% business use, you can't do that. It has to be more than 50% business use for you to be able to write off the purchase price. And here's a lot of other hurdles and maybe sort of drawbacks, negatives to this. If you are going to buy a vehicle in the name of your business and write off the purchase price, you cannot also take mileage. Okay, so it's one or the other. And the downfall with that is if you buy a vehicle and you plan on owning it for, say, 5, 6, 7 years, the downfall is now you've got a big, huge deduction in year one, but now you're losing in years 2, 3, 4, 5, 6, because you can't even write off your mileage in those years. Now, the offset for that is that because this is now a business asset, you can actually write off your gas, repairs, you know, and those sorts of things, because it's a business asset. So there's a little bit of an offset to that, but just keep in mind, you cannot also take mileage if you now have bought a vehicle in the name of your business. Another drawback with that is that, let's say you do buy a vehicle in the name of your business, big, huge write-off in year one, but then in year 3, you go and trade in that vehicle for another vehicle. Here's now a huge negative, because whatever value you get for that vehicle on the trade-in, it ends up becoming income for your business. You know, you have deducted the purchase price previously, and now you've gotten consideration for a business asset. It is as if you have sold that vehicle. So now you have to pick that up as income. Now, you may very well be buying another vehicle for the business in that process, And so if the vehicle you're buying is worth more than the trade-in value, then obviously you're still getting a net deduction in that process, but it is going to be diminished by whatever the trade-in value is. So just keep that in mind, because that's something that might come into play down the road. And I know I'm spending a lot of time on vehicles, but I know this always comes up, and there's a couple of more things I want to mention. A sort of negative for having a vehicle in the name of your business is your insurance is going to be higher because you now have a commercial vehicle, not a personal vehicle. Your personal property taxes for your locality is going to be higher because you're not going to benefit from the relief that individuals and personal vehicles get. And then here's a big, huge negative for me, and this is probably the largest reason that I've talked people out of buying vehicles in the name of their business, is it's a liability. If you get in an accident, God forbid, and you hurt someone and you're sued, yeah, you've got E&O insurance and you may have an umbrella policy, but your business is being sued now, and this is going to affect your livelihood. So just keep that in mind. Whereas, again, we talk about the purchasing of a vehicle. Yes, it's a big, huge benefit in year one, but taking your mileage expense over the years and just having a personal vehicle is very simple. And it's a really good deduction in that scenario as well. So just keep that in mind as you're going through this. The other thing I want to mention here, and this is going to be for some of my folks that are LLCs, being an LLC versus being a sole proprietor, there's really no difference for taxes. It's all liability at that point. So the reason you would want to have an LLC is, again, to have some sort of layer. You sell someone a home and the porch falls and hurts someone, you get sued. If you have that LLC, again, now it stops at the LLC level and it doesn't come after any of your personal assets. Whereas if you're a sole proprietor, your personal assets could potentially get wrapped up in that lawsuit. So that would be the reason to be an LLC. But again, there's sort of a misnomer that having an LLC changes your taxes or benefits you on your taxes, and it doesn't. Your taxes are the exact same in this scenario. It's only for liability. However, there is definitely a trick, and I have a lot of realtors that I've converted over into being an S corporation, taking their LLC. And if you're someone who's making some pretty good money, which most of my realtors are making some pretty good money these days, taxes become a huge issue because let's just use an example real quick. Let's say that you gross 150,000, you have $50,000 of expenses, your net income is $100,000. Now we have to pay tax on 100,000. Well, in an LLC sole proprietor situation, you're going to pay 15.3% right off the bat, and that's your self-employment taxes, FICA. If you're a W-2 employee, it's what we consider FICA. So you're going to pay $15,300, and that same $100,000 is going to go into your regular tax liability. Could be another 15, 20 grand. Could be $5,000 to Virginia. So now that $100,000, you're paying $30,000, $35,000 of taxes on that net income. Again, we haven't even touched on health insurance and retirement contributions and things like that yet. I'm just trying to lay an example here for you real quick. In that same scenario, let's say we've now made the election to be taxed as an S corporation. The benefit here of being an S corporation is that that same $100,000 is your income for the year, but now you're not having to pay that 15.3%. So already we've saved $15,300. You probably will still have the $15,000 or $20,000 due in regular taxes. But there's a caveat here, whereas when you are an S corporation, the IRS says you can't just completely get out of paying FICA taxes because you're self-employed. You should be paying FICA. And so what they require you to do is to pay yourself a reasonable salary. So now you are a W-2 employee of your own company. And that reasonable salary, if you're making $100,000, I'd probably say would be maybe $30,000, maybe $40,000. I don't know that we would need to go higher than that. So now you're still having to pay that 15.3% on the $30,000 or $40,000 salary, but you're saving the 15.3% on the difference of the 70 or 60. So it is still multi-$1,000 tax savings every year by doing that. Of course, the downfall with being an S corp is you've got a separate tax return that needs to be filed. So that typically is more of a headache. It's more fees to someone like myself to prepare that additional return. Now you've got payroll that we have to run. You've got to issue yourself a W-2. There's typically fees there. And again, sometimes it just takes more time and effort. But at the end of the day, if saving $5,000 or $6,000 a year is worth it, then it's worth it. And let's do it, you know? So that's really a big, huge strategy. And I've got a lot of realtors who we've kind of converted over into the S corp setting, which can really save you a lot of money. It just takes a little bit more, a little bit more time, effort, bookkeeping, record keeping on your side to get it done. So the couple more things that I think I really wanted to talk about here, because again, I warned Allie I could go all day on this. So I'm going to try to cut it off, and we're going to try to have some time for questions and things like that. When you are self-employed, when you're 1099, there's a couple of things that you can really get aggressive with. One of them is health insurance, health, dental, vision. If you're a W-2 employee, and let's say you're paying out of pocket, maybe your employer doesn't have health insurance, you're paying out of pocket, those health insurances are technically a medical itemized deduction, but it has to get over 7.5% of your income, and you actually have to be able to itemize your deductions to even benefit from that. But if you're self-employed in this setting, you can write off those health insurance deductions directly on your tax return, and there's no hurdles that you need to get over. So that's one thing to keep in mind. Two is going to be the retirement savings. There's a whole slew of retirement plans. I mean, yes, there's your traditional IRAs that are out there, but of course the limits these days are $6,500. If you're over 50, I want to say it might be $7,500 or $8,000 this coming year. But let's use that $100,000 net income level again. There are two plans where you can stash a bunch of money away and take a deduction, which are going to be, one's going to be your SEP. It's going to be your simplified employee pension, and it is an IRA, but it's a SEP IRA, not a traditional or Roth. It's a SEP IRA. And in that case, you can really defer up to 25% of that $100,000 into a retirement plan each year, $25,000. And now what you've done is you've saved taxes in the process, and you've basically paid yourself, and you're setting yourself up for retirement in that process. There's another really huge one, which is called your solo 401k. And the solo 401k, not only could you do that $25,000 that I just talked about, but you as the employer can also match that $25,000. And in this case, you could probably even do another $25,000, and you could probably defer up to $50,000 a year on that $100,000 if you had a solo 401k. And again, it's all going to be pending that you've got the cash flow, and that's something that you want to do. But when you're in this industry and you're self-employed, do not forget about retirement contributions. That is going to be by far the best tax deduction that you're ever going to have, is paying yourself, keeping it out of Uncle Sam. And again, you're sort of setting yourself up retirement at this point. And again, why are we doing this? Why are we a business? Why are we self-employed if we're not going to start thinking about ourselves and setting ourselves up for retirement at that point? So with that, I think those were really the sorts of things that I wanted to talk about as far as expenses, some things that, or how do we even determine what our net income is on how we pay taxes? And of course, now the next side of this conversation is how do we actually pay the taxes, and how do we manage this? So there's going to be several things to consider. Because you have income that doesn't have taxes withheld at the source, you are technically required to make quarterly estimated tax payments throughout the year. And if you don't, and you have a big, huge tax bill at the end of the year, the only thing that's going to happen is you're just going to be hit with penalties and interest, and you're going to end up paying more. And not only that, you're just going to have to come up with a larger chunk of change, all at once. And we're going to kind of be behind the curve. So I definitely would suggest you to consider making quarterly tax payments throughout the year. And the due dates for quarterly tax payments is sort of a strange schedule. And don't ask me why the IRS did this, but the first quarter is January through March. Your payment is due April 15th. The second quarter, for whatever reason, is only April and May, and the payment's due June 15th. The third quarter is June, July, August, payment due September 15th. And then, of course, the fourth quarter is actually the last 4 months of the year with your payment due January 15th of the following year. So that's going to be the actual schedule that you're going to want to follow. Now, what is it that you pay in each quarter? And again, there's a couple of ways that we can go about what those quarterly tax payments are going to be. You can make quarterly tax payments for a year based on your prior year's tax liability. So if you made less than $150,000 of adjusted gross income, say in 2021, the payments that you make for 2022, as long as you've paid in 90% of your 2021 tax bill for 2022, you could owe $50,000 and you won't be hit with penalties and interest, because you've met that prior year safe harbor. Now, the prior year safe harbor, if your income, your adjusted gross income is over $150,000, it's not 90% anymore. You have to pay 110% of the prior year tax bill. And I think the thought process there is that if your AGI is over $150,000 a year, the IRS probably assumes that you're going to at least make 10% more, maybe. I don't know. But those are what the rules are, and they just have always been that way. The other safe harbor, and this is a little bit more difficult to hit because it does involve you monitoring your income throughout the year, working with someone like myself to fully understand what your current year tax liabilities are. But the other safe harbor is going to be as long as you've paid in 90% of your current year tax bill throughout the year, then there's no penalties and interest at that point. So again, it sort of gets dicey. It's a little bit hard to manage unless you just want to use your prior year, and so what a lot of my clients do is we'll consult on what all of the expenses are. We're going to do everything that we can to defer monies, to write things off, and we're going to try to get our tax bills down to, as much as we can. We're going to have either a balance due or an overpayment on that tax return. We're going to set out at that point in time what, say, 2022 is going to look like. You're going to make quarterly payments based on that. But then a lot of what my clients do is they'll meet me now, this time of year. Before the year is over, let's update that tax projection. Let's see what your actual liabilities are going to be for this year. Because at this point, you guys know, if there's a pending sale right now, you know about it, right? So you should really know where you land right now. And so that fourth quarter payment that's due January 15th, we will sort of, adjust whatever that payment is or whatever we scheduled previously. We'll modify that fourth quarter payment. Now, the last thing that I'm going to mention here before I sort of just open it up for, comments, questions, and this, again, is a very high level, hopefully this kind of makes sense to everyone. For any of my S corporation realtors, there's a strategy that we employ that is pretty cool and can get you into a situation of not having to make quarterly estimated payments, but it takes a lot of discipline to have a little bit of a cash position at the end of the year. So as we previously talked about, S corporations are there. You're going to save some money. But you have this requirement to pay yourself a reasonable salary, right? And when I say that, it's not what you think of as, oh, I have to issue myself a salary every 2 weeks and make deposits throughout the year. Now, you can do that, but you don't have to. A lot of what my S Corp folks will do is we'll meet right now. Actually had a conversation yesterday, and we determined what that person's payroll was going to be. But let's figure out what your tax liability is going to be. You haven't made any estimated payments and you haven't paid yourself a payroll yet, even though you're required to. We will save that payroll for December. We will quantify, let's say someone owes $20,000 to the IRS, and let's say someone, they owe $5,000 to Virginia. Well, what we'll do is we'll pay them a salary of $30,000. We'll run it through payroll. We'll send $20,000 to the IRS. We'll send $5,000 to Virginia. You'll have the other $5,000 will be some FICA taxes and unemployment taxes. And now you've gotten a net check of $0 But what we've done is we have fulfilled a couple of requirements. One, we've paid in your tax bills for the year now. We've fulfilled the requirement of having a salary. And the best part is that because this was all done through withholdings, it is deemed to have been made evenly throughout the year. So you don't get penalized for not making quarterly estimated payments on your income. Again, hopefully that made sense to everyone, but it is a strategy, and it's a very popular strategy. And I do that with quite a few folks, and not even just my realtor S corps, but a lot of my single S corp owners. We end up doing that, and it's just kind of a cool trick. But again, you actually have to have that $30,000 on hand, because it is money going out. But in that case, we've sort of killed two birds with one stone.